quick background, Portus Wealth Advisors, wealth management firm here in Charlotte, North Carolina. Over the course of the last couple of years, we've really started working with more and more small business or business owners in general, and the kind of the $1 to $5 million net income type level. And so as we've gone down that road, have learned more and more about the business owner, and part of today and going forward is a way to bring that forward. So excited to get this kicked off. John, you want to talk a little bit about our series and introduce our speaker today?
Yeah, so this is the first installment of what we are calling Charting Opportunities for Business Owners. Our plan is on a monthly basis to provide a newsletter, and then the following month an event, whether in person or virtual like we're doing today, covering business topics that owners hopefully are very interested in and can get some takeaways, have an opportunity to hear from a resident expert on the topic that we're covering, give them a chance to share, and then give you guys a chance to ask any questions that you'd like to ask. We're kicking off the series today. We're going to discuss business valuations. Happy to introduce our first guest to the series, Rob Snowden. Rob is with South Park Advisors here in Charlotte. He is very well known throughout the advisor community. He is the best of the best among business valuations. Rob, welcome. Thank you for joining us. Do you want to give us 30, 60 seconds on yourself and your firm before we get kicked off?
Sure. Thanks, William and John, for having me here. As John said, my name's Rob Snowden. I'm the founder and managing director of South Park Advisors, an independent business valuation firm that spends a lot of time in the business succession planning, wealth preservation space. It's about 2/3 of our business. We value companies anywhere from Main Street businesses up to $1 billion in revenue, and we're non-industry specific and literally have been involved in hundreds of different industries and industry subsegments. We prepare valuations for estate and gift tax reporting, business succession planning, exit planning, buy side and sell side ESOP representation, as well as get into litigation and family law. Some of the unique niches that we have are mediating disputes between business owners to keep them out of the courts. And we have offices currently we were headquartered in Charlotte with offices in Rochester, New York, and Phoenix, Arizona.
It's awesome.
So format today, Rob, I know you could talk for probably hours and hours about valuations and the ins and outs, but what we're going to do is William and I are going to ask you a few questions that we think are probably top of mind for business owners, give you a chance to answer those, and then, like I said, at the end, we'll open it up, see if we have any other questions.
Okay, great.
So to start off from a high level, a business owner that is considering selling their business, what do they need to think about before they get to that point, right? As they're starting to think about, hey, over the next 3 or 4 or 5 years, what should I be thinking about in terms of my business succession? And then who should be involved in the planning of getting it to where I want it to be?
Well, I think as a business owner myself, we get very accustomed to managing our businesses and working through our day-to-day, and sometimes lose sight of our long-term professional and personal goals. And if there's one thing I could impress on business owners today is that, exit planning, it takes time. What I can tell you from my experience is about 1 in 25 are active in their estate planning and their business succession planning. The typical client that we work with is average about 78 years old. And sometimes they're just getting to the point of exit at 82, 83 years old. In general, it takes about 3 to 5 years to develop a good succession plan. Business owners will get focused on one thing or another. The main one might be, well, what's the value of my business? The other might be, more emotional. I've done this my whole life. What am I going to do when I retire? That can come into play. Typically what we see is a situation where, there's, somebody's passed away, it's been a birth of a grandchild, or there's been a significant health event. And then that business owner wants to exit the business immediately. And that's often at a cost that they're willing to take a discounted price on their business just to get to the next stage of their life. In terms of who should be involved in the planning process, it's very important to understand that there are a lot of things that go on when you're trying to sell a business and get to retirement. So obviously the value of your business is important. You want to have a valuation advisor or an M&A professional involved. You want to have a CPA, an accountant involved, because, okay, we have to sell the business. So what are the tax implications of that business? And there may be ways to structure that transaction so that, it's tax advantageous. The third person that should be involved, obviously, is your corporate attorney, to help you to protect the deal, to protect you against the reps and warranties that are associated with the deal, and cover all the legal aspects. And then finally, once you do, achieve that successful sale, you need to bring your wealth advisor in to help you to manage those proceeds to ensure that you're going to live comfortably into retirement.
So if I'm a business owner, a lot of the times I'm just focused on one potential buyer, right? And just selling 100% of my business to this buyer, not necessarily thinking that there are other options. What are other options if that's not necessarily what I want to do?
Yes, certainly, when you think about, there are 3 or 4 main options. One is you sell to insiders, you sell to a key management team or key employees. You can sell to an outsider, whether that be a third-party buyer, private equity group, or industry participant. And then the other avenue is that you can potentially sell the company to your employees. And each has its pros and cons, and certainly need to be weighed and thought out. Not every company is perfect for an employee stock ownership plan, but those that fit that mold and that criteria and that culture tend to perform very well. For business owners that are looking to really just maximize the value of their business, sometimes going the M&A route's more advantageous. But what we often find with clients and business owners in the Carolinas is they're really worried about, Richard and Barbara, the employees that have worked with them for 20 or 30 years, what's going to happen, when I retire. And certainly there are ways that you can structure the sale of your business to ensure your legacy and to keep that business potentially moving forward so that, it does benefit the employees in the future.
So, no, it's great point. I mean, I think a lot of business owners, they care deeply about those folks that have been around them for 15, 20, 25 years and want to make sure they continue to have a good path forward. As we dive into the valuation a little bit, can you talk about what's the valuation process like, right? What should a business owner expect? They come, they sit down, say, Rob, I need a valuation. I want a valuation. I want to have a better understanding of where I am now, where I need to go. What should they expect out of that process?
A good valuation professional will try to understand what you're trying to accomplish and structure the engagement around meeting those objectives. While there's a lot of math involved in finance and financial theory, you have to truly understand the facts and circumstances surrounding the engagement process. So, a good valuation team the first thing they're going to ask you is, why do you need the valuation? What are you trying to accomplish? And set the stage that way. Then the next part of it is just, getting into information gathering, getting all that financial information and trying to become almost what we term situational problem solvers. Like what is the business doing well? What is the business not doing well? What are the economic what are the economic and industry conditions like at the time that we're trying to value the company, and where's the company headed? So we will digest all that information, and we like to get on a call or a series of calls to talk with the business owners to understand more about the business. The reason being is no one understands the business better than you. So we're trying to get into the heads of the business owners to understand their perspective on the business, as well as develop our own independent perspective and bring all the facts and circumstances together.
Yeah, so more than one way to skin a cat, more than one way to kind of approach valuing a business, right? I think we were talking about this earlier. There are a few different ways that you approach when you bring on a business owner. What are those three ways? What's the differences? When do you do which approach? What makes sense at what point, right?
Yeah, certainly there are different ways to value a business. What I can tell you is that all businesses, for the most part, or a majority of businesses, are valued predominantly on the underlying cash flows of the business. One unique aspect of it, what we would term that to be an income-based approach, is that when you're managing your business daily and trying to get things established and in by the end of the year, is that the number one priority of a business owner is to minimize their tax burden. However, when you're selling a business, what you really want to be doing is maximizing your cash flow potential. So, we're going to discuss within the income approach, what are the necessary add backs. Sometimes it's just easier to take residual earnings and flow it through officers' compensation. So you might be taking above market compensation for those reasons. You may own the real estate, and you may have some discretionary spending going on. And looking at that is important, because at the end of the day, a buyer of your business is only going to pay for the realizable cash flows, what they can recognize as being the true cash flows of the business. So in some extent, if there's unreportable income, it's going to be difficult for you to get value for that if the business owner can't identify it and recognize that it's real. But that's an income approach. We can either look at history as a proxy for the future results, assuming you have a relatively stable or predictable business. But in businesses that are growing and adding new product lines and locations, it's generally more appropriate to look at a discounted cash flow analysis, where we forecast out 3 to 5 to 7 years of your expected cash flows based on the items that you're putting in place to create that growth. What are the factors that are driving that growth? Now, usually when we talk about forecasting, it really makes business owners very uncomfortable. Well, I know what my business is going to do 1 year out, and I might be able to get you second year out, but 3, 4, and 5, well, that gets very difficult. And that's just the nature of forecasting in general. We're taking into account the facts and circumstances of what we know today and trying to predict what's going to happen in the future. Obviously, those financials may change every 6 months, 12 months, 18 months, as new information comes to light and as we get farther into, as we get farther into those years in which we have forecast. The last way to value a business is an asset-based approach, where we simply just take and mark to market the assets and liabilities are on the balance sheet, and what falls out is your equity value. Now, in most I would say in almost all businesses, net asset value really represents a floor value. What you're trying to do is create value above and beyond the net asset value of your business. Otherwise, we term it as kind of, well, you're just making a living. If you're in a situation where your net asset value exceeds your cash flow based value, then an argument can be made in some circumstances that the business may be worth closing down because you can realize value from your assets more than from its cash flow generating capacity.
So in other words, the business isn't profitable. The forecasting is it for not to be profitable, and then take the net asset value, shut it down, take the equity.
It happens.
Yeah.
In some circumstances.
Talk to me about fair market value versus strategic value. You hear those keywords.
Yeah, I think it's very important to understand the difference between fair market and strategic value. Fair market value and strategic value as a business owner. What we see a lot of times is a business owner says, well, my business is worth $18 million and I'm not going to take a value unless it's $18 million. Well, it's not beneficial for a business owner to necessarily get locked in on a particular value, because its value changes again based on the type of buyer that may be interested in the business. For instance, if I'm a fair market value assumes a financial buyer. It's somebody that's going to come in and they're going to operate that business in the same manner that you do currently. And so, it's usually willing buyer, willing seller. You've got a business you want to sell. I want to buy that business. We're going to come to the table and we're going to have equal information. We're going to understand all the aspects of how the business operates, and we're going to come up with a value that's fair and reasonable to both of us. The reality is well, the other type of buyer is a strategic buyer. And a strategic buyer is what a strategic buyer is it's typically an industry participant and sometimes a private equity group, where they're looking at your business to purchase it because they're saying, well, there's some synergistic benefit. It's going to help me to increase my revenues, decrease my expenses, or some combination of that is going to drive greater cash flow. And that's why a strategic buyer is willing to pay more than a financial buyer, because they can realize benefits that a financial buyer cannot. The problem with strategic, trying to estimate strategic value is it's value specific to the buyer. So if the buyer doesn't tell you what their true motives are, you can't necessarily predict what that price is going to be. And it can be extreme. It can be, in some instances, for tech businesses, it can be significantly, substantially higher than fair market value. But strategic value, you can think of it this way: is you've got a business you want to sell. I want to buy that business. You're going to disclose only the information that I ask for, and I'm only going to tell you what you need to know in terms of how I'm going to use the business. And we're going to negotiate, and there's often a winner or a loser in that situation, because the business becomes subject to a negotiated price. Now, if your business is commanding a significant premium over fair market value, well, then the business owner is typically the winner in those transactions from their perspective, from the business owner's perspective, because they're going to achieve value than they would otherwise.
So we talked a little bit earlier about the three different or multiple types of buyers, right? So there's financial buyer, there's strategic buyer, there's key employee, and then there's ESOP. kind of thinking, I would imagine most folks that we talk with initially think more about the strategic and the financial, and maybe so as we think about that, are there different drivers of value or different things that a strategic buyer comes to the table and looks at the business and says that these are my top items, or are there different things that a financial buyer will come to the table with and say these are my top items, or is it all situational dependent, or are there some highlights that you can kind of talk about?
A lot of it is situational, but one of the things a financial buyer looks for is continuity of management. That is a big one. And who's going to run the business? If I buy the business and maybe I'm just an investor that wants the business to operate, if I buy the business, who's going to operate it? So key consideration becomes a focus on who are the key individuals in the business. Can the business operate without the business owner? We've seen a lot of great cash flowing businesses that don't sell because the business owner has, and a lot of times it's one business owner that owns 100%, is the key person, and they haven't built out their management team. They've retained all the control over the day-to-day operations, and they haven't been planning for that exit. So that is a number one concern. The other big concern for financial buyers as well as strategic buyers is the overall quality of financial information. We see a lot of situations where companies grow rapidly. They started with a bookkeeper, and the bookkeeper's done a great job, but now the business is outpacing the capabilities of the bookkeeper. It's become, maybe you started as a $5 million in revenue company, now you're $25 million. So now the books aren't as clean or up to date, or have, issues in terms of the entries that they've made in the books that only get cleaned up maybe by the CPA at the end of the year. Well, what I can tell you from my experience is that, for businesses generally under $10 million in revenue, we spend a lot of time just deciphering and untangling financial statements before we even begin valuing the company. As you get larger, say, 15, 20, 25 million in revenue, typically you've brought in a controller to help out, and potentially a CFO as well as you get larger. And now you're also requiring a greater level of financial reporting from your CPA, and it makes for a much easier sale in those instances. In terms of a strategic buyer, what their main look is, believe it or not, is, depending on the nature of the purchase, a strategic buyer might be looking mainly at cultural fit. I've got 3 or 4 companies that all operate the same, and if I bring in this 5th company, is it going to fit with the culture that's already established? Because one of the things that can impact the value of a business, is whether or not the next business in is going to fit. It has big financial implications, and we've actually seen situations where companies have had to unravel because of the lack of cultural fit. The other thing, strategic buyers looking for potentially is, if I purchase this company, what synergistic benefit? Is it a system? Is it a process? Is it a product? Is it service? Is it people? We valued a manufacturer of a pipe company that had the small end of the market and the large end of the market, but they didn't have the middle of the market, and they paid a really great price to acquire a private, closely held company that filled that hole. And so they expanded their capabilities to offer piping across their entire customer base.
No, really good point. You mentioned a little bit in there about the issues that pop up as you're starting to dig into the valuations of companies, and just thought it was a good chance to kind of untangle that a little bit. Like, what are some big issues that you typically see? You walk in, first time valuation for the business owner. It's classic to see this isn't right or this isn't right, or they're big kind of takeaways of um, kind of synergy top issues that pop up for business owners as they go down this path.
Some of the top issues are, dealing with non-operating assets is a big one. So I own a business and I own it 100%. And on the balance sheet of the company, I have artwork. I have, $4+ million in excess cash parked away for a rainy day. And I've even seen situations in my career where there's not been one Learjet, but there's been two Learjets. And so when you're thinking about business succession planning and exit planning, and someone that's owned, or a few people that have owned a business, and not had to worry about these items, is that any assets on the balance sheet of the business belong to the shareholders of the company. So, removing, any real estate that's not used by the business, any non-operating assets, and getting the excess cash off the balance sheet, you're going to have to either do it sooner or later, because obviously those aren't the items that you want traveling with the sale of the business. And certainly big assets, like, the plane example is a good one, is, you want to get that off the books of the company. Other key issues we see are, family members not active in the business and drawing salaries. It's good to get that off your books as you get closer to an exit. Or, we own the real estate in a separate entity, which is good, but we're paying above market or below market rents, cleaning that up. And then getting any of those discretionary items, family trips that have booked on the business, cars, car-related expenses. I've seen college fees, country club memberships, all those types of things. We call just cleaning up the books of the company. It's better to run lean and mean, especially as you get closer to a potential exit.
That's great. Good point.
Rob, talk to me a little bit about debt, right? Dave Ramsey says no debt. But if I'm a business owner and I'm looking to grow in anticipation of selling, is debt a good thing for me? Should I want some debt? Should I get rid of debt before I start to get a valuation? What do I do with the debt?
It's interesting to see in the Carolinas, especially, is a lot of business owners being very debt averse. Debt is not bad if debt is used correctly. Obviously, there are certain situations where companies become over leveraged and it starts to work against them. But I think what business owners fail to realize is that debt is way cheaper than your equity, and it may not be clear, but if you think about, cost of equity for a business is generally, between 18 and 22%, let's say, for a middle market company, just the cost of equity, and debt at, 4, 5, 6, 7%. It's generally a great vehicle to use as leverage. And what I mean by that is, if you can borrow and leverage new assets to organically grow the business, then you're doing it at a much cheaper rate. You're earning a greater rate of return than if you just use the cash out of the business. And I know it seems weird or uncomfortable for some business owners, especially, sometimes I hear, well, Rob, I've got $3 million of cash in XYZ bank and I want to borrow this loan and they want me to personally guarantee the loan with the cash I have in the bank. I'm not borrowing my own money. Yes, you are in a sense, but it does help you from a business standpoint to employ financial leverage, especially when it's done in a prudent manner.
When you think about that, you mentioned assets that weren't being utilized appropriately. You think about not appropriately utilizing or leveraging debt. When somebody comes in, a strategic buyer or financial buyer comes in and they look at the business and they see, I don't want to say mismanagement, but undermanagement of the resources of the business, does that count against the business owner? Or does it, or do they look at it and they kind of lick their chops and say, man, we can really make this thing hum a lot faster? How do they look at some things like that?
Well, any strategic type buyer, like, when, just think of, us as consumers, when we go out and we buy goods and services, we're trying to get the best price we can for the value it conveys to us. So, a private equity or an industry participant that's looking to purchase your business is doing the same thing. And if they see things that are, I guess, quirky in nature or not like they would expect to see them based on the average industry participant, they may start to use that as a negotiating advantage against you. Well, John, you got a great company here, but your systems and processes are really, really bad, and, while you're commanding or asking X price, we really feel Y is more important because we're going to have to come in and fix all these issues. So, a potential buyer like that is looking to lower the price, and they're going to point to anything that they view as or that could be construed as potentially weak to hit your pain points to drive the price down.
So, Rob, I've decided that I want to exit, right? And I'll do another 3, maybe 5 years until I want to completely be gone. I want to play some golf. What issues should I address? What are the most important issues, I guess, I should address over the next 3 to 5 years leading up to it? So,
real quick, you can't do that because you can't play golf. You're gonna have to find something else to do first.
Learn how to play golf. Right? Starts with lessons.
So just understand that it takes time. And, one of the biggest things that we see business owners working through is who do I want to sell my business to? There are very few that go, I just want to be out. I want my proceeds and I want to be done. I'm just going to sell through M&A or business broker, and I'm going to be done. That's typically not how most business owners think. Most are on a journey to try to figure out where they want to leave their business and what their legacy they want it to be. So often what we see, is it's really typical for business owners to want to transact, to insiders, a management team. Coincidentally, what's really interesting is that, a lot of sons and daughters, they don't want to be active in their parents' business. They've either started their own business or, they've seen the way mom and dad have worked, and they just don't want to continue for that reason. So the next choice is, well, my management team's been with me 10, 15, 20 years. Maybe the management team will want to buy the business. How that typically happens is it's done typically at fair market value. A financial buyer, it's a business owner that's not looking to get every dollar out of the business, but just wants a fair price. And it's structured in the sense that, typically those managers don't have the cash to purchase the business 100%. It might be, well, we need you to have some skin in the game. So, you got to, the 5 of you got to come up with 20% down. And then the rest is structured as a note, as debt. But what in larger businesses, that really starts to be problematic. And the reason is that, where the cash flow is going to come from to pay down the notes. Well, typically it's out of some type of bonus program that the business owners, developed to incentivize the management team and help them to purchase the business. The problem that we see is that it takes a long time. So the next, stage is, well, maybe I should consider selling the business. And they might contact an industry participant. They've known their competitors for years, and they might just go into a diner and sit down and say, hey, this is what's going on, and would you be interested in buying us? And then they might think about that a little bit, and they might say, well, maybe I should sell it to the employees. And ultimately, it just takes time to work through that process. So while you're working through just that, again, you've got the time of that, you've got the emotional component. If your identity's been tied to the business, and you're known in the community as being the CEO of your company, and it worked really hard building the business, then the prospect of retirement can be something that you might not want to face. And we often see business owners kick this can down the road as long as they can, a majority. So you want to be thinking about that aspect of it, and working from there to say, okay, well, while I'm working on these things, I also need to be putting my advisors in place. We need to start talking about these options, and for both, even in terms of a third-party sale or an M&A sale, they say, well, the average sale takes 6 months. What I could tell you from my experiences is most go out 18 months. So you have to factor all these considerations in between your accounting, your advisor, your personal and professional mindset. Where do you want to be? How you're going to sell your company, and how am I going to achieve that liquidity ahead of time to reach that goal? That makes sense.
Yeah.
So Rob, you touched on this a little bit before, but we all know that having a good business leadership team in place, right, in addition to yourself as the business owner, is huge, because whoever's buying the company, right, if I'm just leaving and exiting as the owner, and I'm providing really the value for the business, having that leadership team that can take over and continue to provide, cash flow or profitability from the business is huge from the buyer's standpoint. How do you quantify that in terms of the added value of the valuation of the business?
Well, that's a good question. And I guess, part of it is recognizing that valuation professionals and M&A advisors and business brokers, we estimate value, and we do our best to estimate it. But the reality is that the price for your business will be determined when the hammer drops. It'll be determined when the market sets the price. So it's good to have more than one buyer. Sometimes it works when one buyer comes to the table and it's very mutual, but it's good to have at least 3 buyers interested in your business so that you can command the market price. And the market will actually set the price. Answer your question?
Yeah, no, that makes sense.
Another question, no?
Yeah, I have one more.
Okay.
Yeah.
No.
So from my background is more estate planning, right? From an estate planning standpoint, my recommendation is, hey, if you've never had documents done, get your documents done. If you have had documents done, at least take a look at the documents every 3 to 5 years, make sure that they're still relevant. Legislation changes, life changes, a lot of different things changes. As from a business valuations standpoint, do I need a certain event, right? I'm getting a succession plan done, or I'm trying to sell. Do I need something like that to occur for me to have a business valuation to update? How often do I need to value my business?
Well, I guess what I would say is that, if 60 or 70% or more of your wealth is in the value of your business, and you're, 10 years from retirement, it's beneficial to get a valuation so you know where you stand today, just in terms of the value. Because really if it's a major asset, then all your plannings, most of your complicated planning or will be around the business. So, if you get a valuation and it comes in at $20 million, then, at least hey, this is a starting point. And it might be, well, hey, I've grown the business far enough that if I had to leave today, that the value I could get from my business would support my, my retirement, the way I want to live it. Or you might have to say, well, I'm at 20 million today and I need to get to 30 or $40 million. And you need to start planning to enhance your value and get there. So certainly getting a valuation earlier is good, just to establish a foundation for all the planning that you're going to have to think about in the coming years. How often do you need to get a business valuation after that? Well, it depends. If you've had, if you valued it, if your business was, valued 5 years ago and your revenues have doubled, it's probably a good idea to get a new valuation, because it's likely the valuation of your business has changed. If you're mature, stable, relatively stable, and you grow around inflation, but your cash flows are good, well, it's probably less of an issue to get a valuation, even though it's 5 years old. You may say, well, it's 10, maybe I'm like 12 or 13 million. But again, it really boils down to what you're trying to accomplish. Are you starting to put your management team? Are you going to incentivize management through, synthetic equity vehicles like stock appreciation rights, warrants, options, so that, they're incentivized over the long term to remain at the company while you're planning all these activities? Well, then that's going to require you to get a valuation more frequently.
Yeah, no. So when we think about our industry, somebody asked us, what should I look for in a financial planner, right? And we talk about fee only or this or that or those other components. So as we, think today and talking to, business owners on this side of this computer, besides middle-aged Charlotteans who are Buffalo Bills fans, what are the common key characteristics that you would recommend business owners look for in a valuation expert like yourself?
Well, certainly,
Certainly Bills fans.
Certainly Bills fans.
Yeah.
Well, certainly experience in our industry matters. I've been valuing companies for 25 years, and I've valued well over 2,000 companies in my career, and having experience and witnessing firsthand how business owners make and lose money is an important aspect to being realistic about the value of any business. So, generally, I would say look for an accredited senior appraiser with the American Society of Appraisers, which is what we are, ASA, someone that's accredited in business valuation by the American Institute of Certified Public Accountants, or a chartered financial analyst. Those are the only three that I would, say are really heavy in experience. Understand too that, there's that old adage, in your life, you get what you pay for. There's a lot of people offering valuations now at rates that don't make sense, or they're using some type of valuation calculator. I can tell you that I was involved in a situation with a business owner, two business owners, one not getting along with the other. The business owner went to a website as part of a valuation website as part of their buy-sell agreement, input the information, came up with the value of the business, and used that as their negotiation. And it was probably 50% greater in value what the business is actually worth. Why? Well, it's one thing to have access to a calculator. It's another thing to know how the information should be entered into the calculator. And I've seen $7, $8, $10 million swings in value with valuation calculators. So just understand the information's only as good as the people are putting the information in. And they can create incredible problems. The other thing a valuation calculator is so far, who knows with AI coming, but a valuation calculator can't take into account the facts and circumstances and solve the problems and think about the issues and how that impacts the result. So certainly someone in certain industries, having somebody specific to your industry, like banking is very specialized, having an expert in banking. But most other industries, or maybe oil and gas would be another one, a very specialized industry. But most other industries, manufacturing, services, tech, distribution, transportation, professional services can be handled by a really good and experienced valuation professional.
Yeah, no, good point. And Bill's man, right?
Yeah.
Yeah. So, hey, thanks for, coming and sitting down with us for a little bit today as we think about wrapping up, and we've talked a little bit about valuation, the process of selling the business and other things. We encourage business owners to get a valuation because of what you said, right? It's good to know what the business is worth. It's good to know where it's going. It's good for planning purposes and all these other things. In your view, what's the one of the more beneficial aspects to the business owner of getting a valuation today?
Well, again, I think it's just reiterating that that the process takes time. I give you two examples. One really incredible gentleman, smart, with a really smart business owner, had been working in his industry for decades. I met him when he was 78 years old. He brought me in to do a simple valuation. He called me back 6 months later, and we started talking about he had a potential buyer that was one of his largest customers. We went through a couple rounds of that. He considered, trying to bring in an outside president to run the business. Went through a couple of those, and ultimately it was 82 years old, and we helped him to establish an ESOP and sell it to the employees. In another situation I was in recently, I just met a gentleman. I talked with him in 2020 at the height of COVID. At that time, he was 78 years old. He's now 82 years old. We're trying to keep him moving with his exit planning, but he still hasn't been able to come to terms with, letting go of the business and retiring. That's ongoing, and I can say in the latter case of that, it's likely that he will pass away before the business is sold. And that's not a situation you want to be in. Then it's gonna fall to your family to come in and try to fix the situation, whether that be through the continued operations or getting it sold. And it can really be a cumbersome process. And in the interim, it could impact the value of the business simply if it's known in the marketplace that Joe's passed away. Hey, there's an opportunity here. It becomes a potentially discounted sale.
To make light of the situation really quick, maybe if you have a poor golf game like John over here, you should hold on to the business for a long time. That way you don't have to go chase golf balls around the golf course, right?
Yeah, absolutely. I mean, I could tell story after story of just situations where, I'm working with another business owner. Uh, their business 5 years ago was worth double. They've had to reduce headcount by half, and that person really wanted to retire. And now what do? You either have to sell it, you're not going to maximize your value on exit, or you're going to have to work 5 to 7 years longer to be able to get back where you were. And that just happens to be a business that's sensitive to changes in market conditions. It had nothing to do with their performance. It all had to do with just changes in market conditions.
So would you say that's helpful right there then, Rob? The more frequently you get your business value, the more you understand what your business is worth. And maybe that's a potential opportunity for you to recognize, hey, now is the right time for me to exit out of this business because it's valuable here or it's valued here. I know where it is. I know what it needs to get it to the next level, and I'm not ready to make that next 5-year commitment. Is that a certain benefit of it?
Oh, no, certainly it's a benefit to getting a business valuation. Again, it drives a business owner's thought process, and this is where we are today. This is what we're worth. These are our strengths, weaknesses, opportunities, threats that we face, and when is the optimal time to exit? I know some individuals that are very big into investing in cryptocurrency, and cryptocurrency is very volatile, and they're always chasing, well, I'm up 300%. I just need to be up a little bit more. And, you can get on the hamster wheel trying to chase value. And sometimes it's just better to know, hey, the last 7 years, I doubled the value of the business. Now is the time to go, because what's going to happen? For instance, we've been stimulating the economy since 2008 and 2009. We were hit with the 08, 09 market crash, and then COVID, 19 impacted us. And then we even had to, stimulate the economy coming out of COVID. And, on average, we have a recession every, 7 to 9 years. What year are we on? 9 or 10, and we haven't had a recession yet. Well, at some point, we're going to have a recession. We hope it's a mild recession, but it's more likely than not we're going to have an economic recession. So you may be in a situation today saying, hey, my business has got great value. I should go now rather than the two years from now that I've been thinking about, to avoid that potential downturn in the market, which could impact the value of the business.
And that frequent valuation gives them that knowledge of, hey, the business is now worth, rather than the assumption of, I think it should be worth, or
yes,
buddy said it is worth, or I read in a newspaper clipping that business was worth that, and therefore my business is too. Getting an actual valuation gives them that direction.
Yes.
So, well, Rob, thanks again for joining us. Caitlin, open it up for questions. I don't know if anybody's chatted questions along the way, or if everybody's been calm and polite. If you want to unmute yourself and ask the question, can we do that too?
Sure, yeah, and if you feel more comfortable throwing in the chat, please do. What is the typical cost and duration of evaluation?
Again, it depends on the facts and circumstances. There are different types of valuation reports. There's what we would call, a full valuation report, where we're talking about the history, the operations, the finances, the economic and market outlook, and what's the financial performance? How does that financial performance of the business benchmark against its industry peers? We take all this information, we synthesize it into what we believe the value of the business is going to be. That can range from, it could be 10,000 to 50+ thousand dollars. A typical business around 15 to 25 million in revenues, probably around $10,000. But again, it depends on, how many methods are we going to need to value the business? Are there any potential non-operating assets do we have to consider? What is the capital structure of the business? Is it relatively straightforward? Is it just one class of common stock, or do we have a complex capital structure? And all of these things will culminate in what the real price is. For a restricted report, we consider all the exact same information. And generally for a same size company, generally in the range of $7,000 to $9,000. But again, they can go up. I've done valuations for, $9,000, and I've done them for over $100,000 with multiple entities. So it just depends. But I would say a good range is, maybe 10 to 12 on a full report for a small to mid-sized company, and maybe 7 to 9 on a restricted report. Both of those are signed opinions. There is a version of a report out there called a calculation of value. This is put out by the AICPA, and a calculation of value is the appraiser and the business owner are going to get together, and we're going to agree upon the methods, and we're going to calculate the value. Well, we don't do calculations of value. We rather do restricted reports and sign our name to our opinions and say this is our professional opinion on an estimate of the value of the business. A calculation of value is simply that. It's a calculated value, and it can be right, wrong, or and so we don't issue calculation of values. They do have their place, but I don't think that they can be problematic in an exit planning situation.
So I know you're going to say it depends, but start to end of getting that value, how long does that typically take?
Generally, it takes 4 to 6 weeks from the time we collect the information we need to get started. The whole process is about 4 to 6 weeks. I would say right now the heightened estate planning, we're running about 6 to 8 weeks, and expect that to maybe even go 8 to 10 weeks as we get into 2025.
So, stay on that note for a second. I assume that the process is business owner, you meet, kind of first meeting, idea of what the business is, and then they provide you with paperwork, and then you provide a quote for them, what it would cost to do the valuation. Is that generally speaking correct?
Yeah, it usually starts with an initial call to find out what's driving the need for the business valuation, and we talk about the company a little bit, and just the facts and circumstances surrounding the need. If the business owner wants to move forward, what we do is we issue an engagement letter, and there's a retainer. And once we have those two items, we get an information request out. So these are all the items that we need to value the business. Again, we ask for a lot of information, so that we can learn what about the business. And then it starts after we have the information. We set up a management call to discuss the business and the financial statements further. And once to make sure we've got all the information we need, we may have some follow-up information that we need to request. After we do that, we issue a draft report, and there's generally one of two ways. Either the client looks at it and says, yeah, that's exactly what I thought, and things look great. The other might say, hey, do you want to get on a call and so we can discuss this further? And we will. We'll take them through the report and explain why we valued the company the way we did. And once we're wrapped up, we issue the final. It's electronic. We sign it, and that's pretty much the entire process from start to finish.
Okay, great, thanks.
Hey, Rob, what is the general minimum level of revenue and or EBITDA that your level of valuation that is appropriate for your valuation?
Well, what I would say is that we valued all the way down to Main Street businesses that were under $1 million in revenue. We don't do a lot of Main Street businesses, mainly because it's not always cost beneficial to the business owner to have us value a Main Street business. We're generally more suited for businesses 5 million in revenue up to 500 million in revenue. But there are situations like, for instance, we work in family law, and they need a very small business valued, and we value them for that purpose. And in that case, it makes sense to spend money with us to value a business, to give them that purpose. But the best way to have very small businesses valued are to really go to a business broker where the sales are occurring more frequently, because the smallest Main Street businesses are sometimes the most hard business to value because the information's limited, and it's essentially a lot of small businesses it's your business is your work, you have your business established to earn a living. And so there may not be much value past what you're paying yourself in salary and compensation.
So 500,000 to $1 million in revenue, kind of that classic business broker is going to.
Yeah, they're gonna do a much better job.
1 to 5 million is going to be situationally dependent whether or not it's worthwhile having it. And then once you get over $5 million, it becomes pretty normal and pretty relevant to bring somebody like y'all in and pay.
Yeah.
So you might take the $1 to $5 million business and say, hey, look, spend it once, and then probably don't do it again for another 5. Get yourself your benchmark point for where you are now, and then try to get further along down the path and come back in 5 or 6 years and get another valuation and see where you made it.
Yeah, certainly we'll value any business, and I'm very candid when a business owner calls me. I say, look, this is what it's going to cost you to value the business with us. But if you don't need this right now, you're better off going over here and you're going to save. For instance, our standard hourly rates for managing directors are $350 an hour. Our senior staff are $250 an hour, and our junior staff is $150 an hour. So you have to be in a situation where it's beneficial to pay those amounts in support of the opinion.
Yeah,
for the need.
Oh, wait, I think we've got one.
I mean, if
Other
there's time
questions out
left,
there?
I
I'll
don't
take
see
some.
any other questions out here right now.
So thanks
Yeah, if
for
anyone wants
that.
to
That was my
unmute
minimum
and
question because we're
ask,
pretty
you're
small.
welcome to, or
But
now's the
Rob,
last chance to
you
kind
kind
of
of
throw
mentioned
into
like
the
when the
chat
more Main
as
Street is
well.
going out to brokers. So
Before we
shameless
let Rob
plug,
go
but
here.
any kind of contextual things that you can just elaborate on people when you're dealing with brokers of like test questions and how to, validate them, verify them, vet them, because there's a wide range and a lot of industry reputation on those folks, or is that too hard of a softball question?
It is a very difficult question, but I know exactly what you're saying, and I've run into this situation. We have very good business brokers in general in Charlotte. When you get outside of at least Charlotte, and even in Raleigh, we have some good brokers. It gets a little bit more difficult, I guess. How would I do this? Certainly I want to know their experience, understand that when you do get what's called a broker opinion of value, that, it's not a professional business valuation. They're looking at transactions, and often they're looking at what an SBA lender would be able to provide financing for. But the ultimate goal of a business broker is to sell the business. So you might get a free valuation, or they might charge $1,500 to $2,500. But it can be very challenging to identify which broker to use and which broker not to. And the best thing I can tell you is that talk to your other professional advisors that you trust and say, whether that be your wealth advisor, your CPA, and say, who would you recommend and why? And then I would interview 2 or 3 before I selected one. But it's really interesting. I was in a situation where I was valuing a business in Florida, and it was a high cash flowing business, but the broker was arguing, well, I can't get the business financed for that rate. And they were basically lowering the value of the business to meet the SBA loan guideline. So be aware that that can happen too, but in certain businesses, that might be what you need to do to sell.
That's tough.
It's tough.
Yeah.
I've never
So-
heard of a broker reducing the price to accelerate a transaction before. That was sarcasm.
Yes, if you understand how brokers, and like I said, they're really excellent brokers out, but understand that brokers are 1099. They're not W-2 employees, so their compensation's driven on deal activity. So their goal is, I want to maximize value, but at the fastest possible transactions so that I can be paid. And so it becomes a competing issue, and that is that broker working in my best interest? I've seen good and I've seen bad, so it's a tough. It's tough to give any really good guidance other than understanding that broker's reputation and getting the recommendations of your other trusted professionals.